again, in the world of the physical sciences, you can probably bet that that's true. And the electrical engineer knows that if he turns on a light switch over here, the light will go on there every time, because it's subject to physics, not in the world of investing. And so for every possible phenomenon, there is a range of things that can happen. There may be one where it's possible to discern which one is the most likely. And if we draw a probability distribution, that may be the highest point on the distribution, the most likely single outcome. But that doesn't mean it's going to happen. And the reason we don't have many probability distributions that look like this, but rather that look like this, is because a range of things can happen. And it's very, very important to notice that, number one, there are lots of things that can happen, so you have to allow for them. And number two, the thing that is most likely to happen is far from sure to happen. So that's very key. There's a professor at the London Business School who put it succinctly. He said, risk means more things can happen than will happen. And this is profound, in my opinion. In the economic world, people generally make their decisions based on something called expected value, which is to say that you multiply every possible outcome. First of all, of course, you don't think in terms of a single outcome. You think in terms of a range of outcomes. So you take if you could iterate over so many, you take every possible outcome, you multiply it by the likelihood that it will happen, you sum the results, and then you get something called the expected value from that course of action. And you choose your course of action based on the highest expected value. And that sounds like a totally rational thing. But what if the course of action that you're considering has some outcomes that you absolutely can't withstand? Then you may not do it. You may not do the highest expected value course of action because it has some you can't live with. You know, who here is willing to be the skydiver who was right 98% of the time, for example. So you may elect to do bike riding on the Google campus rather than skydiving, even though skydiving is more exhilarating 98% of the time. Anyway, so the point is, as I lived my life from learning about Dimson, learning about Taleb, from learning from my own experience, I realized that should does not equal will. Lots of things that should happen fail to happen. And even if they don't fail to happen, they fail to happen on schedule. So the thing that the economist or the financier thinks should happen this year may happen in 3 years. You got to live 3 years to see it happen. One of my favorite sayings is, never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average. We can't live by the averages. We can't say, well, I'm happy to survive on average. We got to survive on the bad days. You got to survive, and if you're a decision maker, you have to survive long enough for the correctness of your decision to become evidence. And you can't count on it happening right away. I always remind people, overpriced is not the same as going down tomorrow. And if you bear that simple truth in mind, I think it helps. So Taleb and the role of luck, very important. Then John Kenneth Galbraith. John Kenneth Galbraith, for those of you who are not familiar with ancient history, was an economist, American economist, died around 2005, I think, maybe a little after, and at the age of about 98. And he was one of my favorites. He was a little on the left side. He was, somewhere between free enterprise and socialism, but he was what we call a liberal in the days when it was okay to say that word. But he was very, very smart, and he was not famous as an economist, but he played a lot of roles in government, and he was a diplomat. But he wrote some very good books, and one of them is called A Short History of Financial Euphoria. And I like thin books, and his is thin, especially the ones he wrote in the last decade or two of his life were very thin. So I enjoyed those. But the short history is very good, and I recommend that to you. And one of the things he says is we have two classes of forecasters, the ones who don't know and the ones who don't know they don't know. Now, I don't believe in forecasts, macro forecasts. People who forecast interest rates, performance of economies, performance of stock markets. And I don't think that my efforts to be a superior investor and most other people's are aided by macro forecasts. So am I saying that the forecaster is never right? No, I'm not saying that. The forecasters are often right. Last year, GDP grew 2%. Many forecasters forecast that GDP will grow this year at 2%. That's called extrapolation. And usually in economics, extrapolation works. Usually the future looks like the recent past. So usually the people who forecast a continuation of the current are right. The only problem is they don't make any money. Because let's take the economy. Most people forecast 2-something for this year. A growth rate of 2-something is cooked into the prices of securities today. If the growth rate turns out to be 2-something, everybody who forecasted that will be right, but security prices will not change much because that 2-something growth was anticipated and discounted a year or two ago. So all those people who are right won't make any money. Our forecast, so that's a correct. So most forecasts, extrapolation works all the time. Forecasts that are extrapolations work all the time, but they don't make any money. Logically, am I saying that forecasts never make any money? No. The forecasts that make money are the forecasts of radical change. If everybody's predicting 2.4% growth for this year, and if I predict -2, and it turns out to be -2, or I predict 6 and it turns out to be 6, I'll make a lot of money. So forecasts which are not extrapolations, forecasts which are radically different from the recent past, are potentially very valuable if they're correct. Of course, they're not of any value if they're incorrect. And if they're incorrect, they'll cost you a lot of money. If everybody else thinks it's going to be 2.4 and you predict 6 and it turns out at 2.4, you're probably going to have taken the wrong investments and lost a lot of money. So deviant forecasts, which turn out to be right, are potentially very valuable, but it's very hard to make them. It's very hard to make them correctly. It's very hard to make them correctly consistently. And somebody at lunch mentioned an early memo I wrote called The Value of Forecasts. And in one of, there was the value of forecasts, and then there was value of forecasts 2, I think, right? And in one of those, I reviewed the recent history of the Wall Street Journal poll. Every 6 months, the Wall Street Journal publishes the results of a poll of economists. And on GDP growth, CPI, value of a dollar, the price of oil, whatever it might be, a bunch of phenomena. They do it consistently. And they ask like 30 people consistently over time. And so it shows basically that most of the time when people get it right, it's because they predicted extrapolation and nothing changed. Once in a while, something changes radically, and invariably somebody predicted it. But the problem is, if you look at that person's other forecasts over the years, you see that that person always made radical forecasts and never was right any other time. So of course, if you're getting your information from a forecaster, the fact that he was right once doesn't tell you anything. You wouldn't, the views of that forecaster would not be of any value to you unless he was right consistently. And nobody's right consistently in making deviant forecasts. So the bottom line for me is that forecasting is not valuable. And that's something that my experience has told me. So we don't know what's going to happen, and randomness will play a big role in what happens. And randomness is by definition unpredictable.